The S&P 500 just closed its ninth straight winning week and ended May at a record high. Underneath that record, a second market has been quietly falling apart. High quality stocks, the kind we own, have spent 18 months in their own private bear market. This week, our side finally caught a strong bid. Here is what the record high is hiding and how the value aligned portfolio is positioned for it. If we haven't met, I'm Berk's AI avatar. I deliver financial content for free so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Two markets are pulling in opposite directions right now. One runs on artificial intelligence and momentum. The other, steady, high return businesses, have been left behind. Over the next few minutes, I'll walk through the week's numbers, the quality versus momentum split underneath them, and the moves we made in the portfolio because of it. Start with the scoreboard. The NASDAQ heavy QQQ rose 2.9% on the week. Small caps in IWM added 1.9%. The S&P 500 tracker SPY gained 1.5%, and equal weight RSP brought up the rear at 1.1%. That ranking is the whole year in miniature. Growth and large cap technology led again, and the spread between the styles tells you who is steering. The S&P's ninth straight green week is its longest run since 2023, per bar chart. Now, widen the lens to the year. QQQ is up 20.3% year to date. Equal weight RSP is up just 9.5%. QQQ has more than doubled the average stock's return, and that gap has a name: concentration. A handful of very large companies are carrying the index. RSP, where every stock counts the same, shows the typical company having a far more ordinary year than the headline suggests. Sector by sector, the split was stark. Technology ran away with the week, up 5.9%, and it now sits up almost 66% over the past year, lapping every other group. Software was the engine inside that move. At the bottom, energy fell 5.4% as oil had its worst month of the decade. Staples and utilities each slid around 2% to 3%, the natural posture when money chases growth. So, the weekly winners read like a single trade. Dell jumped 32.8% on Friday after raising its fiscal 2027 revenue forecast to about $167 billion on surging AI server demand. NetApp, ServiceNow, IBM, and HPE filled out the list. All AI infrastructure or beaten down software coming back to life. The losers were defensive and chip adjacent names: Clorox, ResMed, Intel, Skyworks, and Coherent. One name on the winners list matters more to us than the rest, and I'll come back to ServiceNow shortly. On the economy, this was the first major inflation report under the new Federal Reserve Chief, Kevin Warsh. Core PCE, the Fed's preferred gauge, came in at a 3.3% annual rate for April, still well above the 2% target. Markets shrugged. The CME FedWatch tool puts a 98.8% probability on rates holding in the 3.50% to 3.75% range next month. Look further out, and traders now see a hike as more likely than a cut, roughly a 39% chance of a quarter point increase by year end. Investors have shifted from waiting for cuts to bracing for hikes. Oil drove the geopolitics. Brent fell about 22% from May, and West Texas Intermediate dropped roughly 18%, the steepest monthly decline this decade. The trigger was a reported 60-day U.S.-Iran ceasefire framework that eased fears around shipping through the Strait of Hormuz. Cheaper energy acts like a tax cut for consumers and most businesses. That weighed on our two energy holdings, Diamondback and Permian Resources. but it helps the consumer and industrial businesses that make up most of the book. Quick note for the serious investors still with me. If you want the deeper teardown of how we actually value these companies before we buy, I'll point you to a companion video at the end. For now, here's the split that explains everything. Here is the week's real story. While the index prints records, high quality stocks have spent the better part of 2 years losing to momentum. That framing is not just ours. Bloomberg's John Authors, who is not given to drama, wrote this month that momentum is trampling quality in market records. The MSCI World Quality Index trailed its parent by 4.7 points in 2025, and the US version lagged by 6.4 points. In 2026, the gap widened further. The pain is visible across the best quality investors alive. Peter Schlegers at Compounding Quality laid out the year to date scorecard, and it is ugly. Terry Smith was down 11.3%. Bill Ackman was down 15.4%. Chuck Akre down 17.2%. And Dev Kantasaria down 20.5%. Even Berkshire Hathaway trailed the S&P by its widest margin of the year, off nearly 11% over April and May, while the index surged. Warren Buffett, speaking in Omaha, called this tape a church with a casino attached and said he had never seen people in a more gambling mood. Peter points out the only other time Berkshire lagged this badly was 1999, right before the dot-com bubble burst. That date should focus the mind. Set against the bears is one of the most respected strategists on the street, Dr. Ed Yardeni. His latest note draws a sharp line between FOMO and FEMO. FOMO is fear of missing out, investors bidding up multiples on hope. FEMO is fabulous earnings momentum, analysts raising estimates because real data gives them reason to. Yardeni argues this rally is FEMO, and his evidence is hard to wave away. Forward earnings climbed 14.4%, while the forward price to earnings ratio actually fell 4.6%, the opposite of a bubble. A record forward EPS of $358.82 and record 15.5% profit margins back him up. He flags one yellow light. Technology's long-term expected growth has hit a record he admits may be bordering on irrational. Estimates can be walked back, and that is the milder failure mode than multiples breaking. We hold both ideas at once with a portfolio built on purpose. The top 60% does the heavy lifting, about 14 of our 34 names, each near 6% of the book, with a target of growing 30% a year. 60% compounding at 30% adds roughly 18 points of return on its own. The bottom 40% is ballast, aimed at plus or minus 2%, which keeps the whole portfolio in a 15% to 25% annual range. That range is the point. At 15% a year, the portfolio doubles in 5 years. At 25%, it doubles in 3. Here is what sits in that top 60% right now. On the technology and AI side, Taiwan Semiconductor, Alphabet, Microsoft, Amazon, Broadcom, ServiceNow, and AMD. Alongside them, businesses with little to do with AI, AutoZone, Roper Technologies, Ulta Beauty, and Markel. That mix is the whole thesis in one list. The AI names earn their seat through returns on capital, the exact same standard AutoZone and Markel meet. We own them because the highest return businesses in the world right now happen to sit in and around AI, not because they are popular. ServiceNow is the one I promised to return to. We trimmed AMD, Broadcom, Nvidia, and Alphabet at the end of April after enormous gains, then recycled the cash into ServiceNow while it was down 42% on fears AI would disrupt enterprise software. This week paid off fast. ServiceNow jumped 40.8% in May, its best month since its 2012 IPO, after signing a data partnership with Experian. That is buying quality on weakness. The numbers show the discipline. Over 5 days, we returned 2.6% net against the S&P's 1.4%. For the month, 7.6% against 6.3%. The stretch when we rotated into our beaten down quality names. Year to date, we trail, up 7.0% against 11.3%, a lingering cost of the quality versus momentum gap. Over the full year, the number that matters most for long term owners, we are up 32.3% net of fees against the index's 30.3%. That 1 year figure lands above the top of our 15% to 25% target band, even after the hardest stretch quality investing has seen since 1999. Three things to carry forward. First, quality and momentum's clothing. We own these businesses for returns on capital, not for the hype. And that standard is why we could trim in April and rotate into cheaper compounders. Second, discipline over narrative. Trim the winners, add to the unloved, and let valuations set position sizes. Third, irrational stretches run long, and they always end. The market is really two markets, and a record index is hiding a quality bear market underneath it. We do not need to win the bubble debate. If Yardeni is right, our AI quality names keep compounding on real earnings. When the bears are right instead, the undervalued compounders we bought are where capital flows next. If this helped you see what the record high is hiding, the next one to watch is right here. That is the discipline behind every move you just saw.